Today I'd like to talk to you about the annual allowance tax trap. Now you might be thinking, what is this all about? Well, the government of the day back in April 2006, I think it was a Labour government, but it doesn't really matter which party it was, introduced something known as pension simplification, and it came into force on what was called A Day in April 2006. Now, the cynic in me did wonder what government would ever bring in any legislation that brings in simplification. It just doesn't exist. It just reminded me of Yes Minister, for people who are old enough to remember that series, and Sir Humphrey of the Civil Service. The Civil Service doesn't work that way, so I was understandably a bit cynical about it, thinking this must be a way of raising taxes. It can't be a way to simplify pensions. As it turns out, what it's led to is not pension simplification. I can only describe it as pensions complication, because it's had the opposite effect. Pensions have now become incredibly complex. So much so, I do wonder sometimes if I'd be better off getting a PhD in astrophysics, which would be far easier than trying to understand the mysterious world of pensions. Anyway, that aside, one of the reforms was to bring in this annual allowance. So it's a limit on how much you can contribute into a pension each year. Broadly speaking, the allowance is £40,000. Now, the trouble is, if you're fortunate enough to be a high earner, and for the purpose of this, what we mean is if you're earning more than £240,000 a year, then for every £2 over £240,000 you earn, your annual allowance gets reduced by £1. So just to put things simply, if you're earning £300,000 a year, you deduct the £240,000 limit, and that leaves you with £60,000. Divide by 2, gives you an answer of £30,000. So your £40,000 allowance gets reduced by £30,000 if you're earning £300,000 a year. Fortunately, not many people earn that level of income. Nonetheless, it's quite a blow to anybody who wants to put away some serious amounts of money into a pension scheme. So the limit can be reduced. It's called the tapered annual allowance, can be reduced from £40,000 to £10,000. But there's a further reduction possible if you, no matter what you earn, if you draw income out of a money purchase pension scheme. There are some exceptions, but generally speaking, for most people, if you draw income out of a money purchase pension scheme, and the most obvious one of which most people are familiar with is personal pension, then that means your annual allowance, the amount you can pay into a pension, is restricted to £4,000 a year, which is known as the money purchased annual allowance. So not very good news for people who want to put money away into pensions, where you can get caught by these various traps. Now, what I wanted to do was to use an example of a client, which we'll call Joe for this example, who has been paying into his own pension, for company pension, for some years, and his earnings are quite good. He's earning about £80,000 a year. He personally pays £20,000 a year into his company pension scheme. His employer is very generous. His employer pays in £25,000 a year. You with me so far? That's £45,000 between the two of them. But also he salary sacrificed £25,000. And what I mean by that is he gave up £25,000 of salary, and in return, his employer will pay that £25,000 into his pension scheme, which is great news because that's a tax-free benefit in kind. However, at this stage, he's still equal. He's still £40,000 going in. It would be the same if he paid it in himself, you would think, except for one thing. If the employer pays the money in, that means the employer doesn't have to pay employer's national insurance on that £25,000 that he has sacrificed, nor does he. Which means that most employers, the national insurance they save from the salary sacrifice that they then pay into the scheme, the £25,000 as example, that national insurance usually gets added to the £25,000, which means he gets more money going into his pension scheme. So it's quite a smart way of getting more money into your pension scheme rather than paying it yourself. Now that's all well and good, and the client, understandably, as he's only personally paying £20,000 into his personal pension, or company money purchase pension rather, he understandably thought that his contributions were below the £40,000 annual allowance. And in fact, it's true, it is below 40,000. But what he wasn't aware of was that the salary sacrifice scheme, HMRC, treat the 25,000 that you've salary sacrificed as still being part of your annual allowance contribution. So that's caught straight away. So straight away, his 20,000 plus the 25,000 annual allowance limitation from the salary sacrifice makes it 45,000 a year that's deemed to have been paid in. But in addition to that, the employer's paying 25,000 in a year. So if you follow the figures so far, there's 70,000 combined pension contribution between the employer and employee. The trouble is the allowance is £40,000. Now, you'd think if there was combined contributions between employer and employee, that the excess amount paid in would be taxed on both the employer and employee. But no, it doesn't work that way. The employer never pays the tax bill. So, because £70,000 going in, and even though the client himself is only paying in £20,000, it's deemed that £70,000 is being paid in by him. So, what that means, if there's a £40,000 a year annual allowance, he's paid £30,000 in extra, he's got to pay tax on that £30,000 overpaid amount. Because the £40,000 allowance isn't a maximum limit, it's the maximum limit on which you get tax relief. Now, the only way you can mitigate that tax bill is if the last 3 years you've got any unused allowances, because any unused allowance is below 40,000. Let's say, for example, he paid in 25,000 one year and the allowance was 40,000. That would mean 15,000 unused carried forward for the next 3 years. As it so happened in this case, he did have £15,000 worth of unused allowance from previous years, which he carried forward, offset against his £30,000 excess contribution, which left him £15,000 net overpaid, on which he had to pay tax at 40%. That's a tax bill of £6,000. Ouch. So there we go. There's one of many, many examples I could give you of the many, many tax traps, these booby traps for unaware pension contributors, particularly people who have high earnings, by which we mean more than £240,000 a year, and or very large pension schemes, which can get caught out by another tax trap called the lifetime allowance. So, fortunately, we have a way of planning to minimise taxes on these allowances, and that's called lifetime cash flow planning. It's so sophisticated, it can even build in tax planning for the annual allowance and lifetime allowance, which many clients who use it find an absolute godsend. So, you know what to do if you're a high earner and or got a large pension and you want to avoid these unnecessary tax booby traps. You know where to come.